Trump is theater, and he's controlled, and his narratives will be part entertainment, part clownery, and a lot of other things. The key fact is that America is quite clearly in a debt-based collapse. It is a secular collapse of empire hegemony. It's not me being a drama queen. I didn't ask for this. I'm just going to tell you exactly what I see. Sometimes it is the big one. Gold got psyoped out of portfolio. It's like having home insurance and suddenly being said that thefts never happen, fires never happen, floods never happen, it's wasted money by our Ponzi scheme. Any nation that is building towards fair money and sound money is not accumulating treasuries. All the Western nations that are captive to this particular genre to varying degrees are slaves. You would need to get up to 107,000 in gold. But that's a statement more about the dollar than it is about gold.
Hi there and welcome back to the Reinvent Money podcast with me, Paul Buitink. I'm happy to have back on the show trader and educator Francis Hunt, a.k.a. the Market Sniper. Last time we spoke was on the 14th of August. We're going to talk a bit more about hyperinflation and about the debt and fiat-based collapse. We're also going to do some proper technical analysis this time for gold, silver and Bitcoin. Last time we didn't have enough time for that, so we're going to do that today. And he has some really interesting long-term price targets for the precious metals and also for Bitcoin. I guarantee you they will blow your mind. Hi, Francis. How have you been?
Good to be back with you. Thanks for having me.
Yeah, it's always good to see you. And last time our viewers really enjoyed the video and all the information that you shared. So look forward to catching up and continuing our conversation. First, let's talk a little bit about what's going on in the world. You're a South African based in Europe. How do you look at things in the US at the moment? Because we have a government shutdown again. But also we heard Trump talking about the enemy from within and mentioning the word war quite a bit. It looks like he's going to purge the system. How do you look at things also from a macro perspective in the US?
So when you talk markets, I tend to, Trump is theater, and he's controlled. And his narratives will be part entertainment, part clownery, and a lot of other things. The key fact is that America is quite clearly in a debt-based collapse and a fiat-based collapse that goes hand in hand with a debt-based collapse. More money is borrowed into existence. I have to keep reminding people it's like Siamese twins that are conjoined at the head. You can't drown the one half. We had a 55% correction in the debt markets by value, capital value, in 2020, the later part of 2020 through to 2023-24. We were the earliest to say there's been a major turn. We picked a right shoulder and got short. In fact, we were before the right shoulder. We caught the sell-off to the neckline that then created a bounce with the right shoulder, and then the eventual collapse that saw 55%. We had puts on the TLT, and we expected a debt-based collapse, and was our first call bearish on the bond markets after a 40-year non-stop bull, which was an absolute widowmaker for bears. But the people don't realize the consequences. I've just got off another interview, and the person is US-based, and they are pretty laissez-faire and relaxed. They think a 2-year bull market in gold, and then, it'll go back to something else. It'll pull back and all of this. It is a secular collapse of empire hegemony. It's not me being a drama queen. I didn't ask for this. I'm just going to tell you exactly what I see. Sometimes it is the big one. Sometimes it is a big fish. Sometimes they're not all like this being sold to you like that. Sometimes you think they're like that and they're like that. It's hypernormalization to think that things will continue in a normal way in an abnormal world, which is about to have its moment of truth after running like the road runner over the cliff edge and kept running and now looks down. This is a huge, huge loss in living standards for Americans, based on the fact that their production is low in terms of exports to the rest of the world, and their imports are high. And the counterbalancing factor for that was they threw bits of paper back at everybody, China, the EU bloc, which you're part of, and said, buy a treasury bill and the dollar, which you would convert by every time you buy a treasury bill, you obviously convert your euros or your Chinese yuan into a dollar, you form a bid for the dollar, and you go buy up the treasuries. Now, the point of the matter is those were supposed to be boring assets that crept upwards in a 40-year bull market slowly, that got an extra bid when equity markets were overvalued and crashed, and they were the counterbalancing, aggregating down of risk in a portfolio, in the 60-40 portfolio. But the 60-40 portfolio was part of a PSYOP that was part of the petrodollar. It was bringing people into a bond market on a far larger scale. Many allocations for assets long before then were, if you look at the legacy Italian families and before this financial notion of the 60-40, always had a gold component for exactly the current currency debasement narratives that we are facing right now. There were often, for example, the classic legacy families had property, a third, gold, a third, and then owned shares in businesses. And the property they held often was income producing, such as olive plantations, vineyards, etc., etc. So gold got, the whole story is gold got psyoped out of portfolio. It's like having home insurance and suddenly being said that thefts never happen, fires never happen, floods never happen, it's wasted money, by our Ponzi scheme. And we've come to the point now where that is being re-rating. There was a recent headline by the chief investment officer in Morgan Stanley talking about a 60-20-20 portfolio.
Exactly,
Again,
yeah.
holding on to the equity component and then cutting in half bonds and suddenly ramping gold from 0 to 20%.
Right,
that's a big
it's a watershed moment, right? Well, how do you did this? Just
very
like,
much.
Yeah, it shaked my thoughts. Like to have a company like Morgan Stanley to come out like that. So is that just the start? Are all the other investment firms going to do the same thing, you think? Or
Well, the problem they have as bankers is they're supposed to be smart on all things financial, and they've been sleeping at the wheel. If people had shorted bonds when we did and made sure they had no debt instruments, they wouldn't have worn a 55% loss, and they would have been whaling into gold 4 years earlier. But they didn't. Now they have to get in front of the narrative, and it's a half measure. There's no point in having bonds at all. It's financial repression. They chronically underperform, and in this case, there's so many of them coming at an ever more parabolic, rapid rate that they're probably going to go to zero in valuation. So it's kind of like, why don't you buy my crashing, bankrupting company in the last year after I've lived off it for 40 years, loaded it with debt and everything? Buy the shares, you'll get a small dividend stream, and then the shares will be worthless. That's not a clever deal. Yes, you're getting income, but you're going to get well below the income needed compared to the true inflation rate. And CPI is the big lie, the next lie. So we called the labor numbers a lie for the last 4 years. When you met the criteria of a recession, it was a recession. Yellen and Biden told you when it was still there, no, it can't be because employment's so firm. Well, we said it was a fake matrix. You'd met the criteria. And now we've seen the unraveling of the narrative on labor in America. They've readjusted so many times by millions of jobs at year end that basically everything you were sold. The propaganda is in the economic statistics, it's everywhere. And I'm calling the CPI as the next one to fall because the GDP numbers don't make any sense. They aren't being real terms re-rated downwards sufficiently. There's a whole new lie. That's the next lie that will be revealed. Mark this note. We called this the labor stats a lie 3-4 years ago. So they're in a contagion of devaluation. The gold parabola, when you look at the quarterly chart, is actually in actual fact the inverted version of the dollar purchasing power parabola. And fiats as a whole, but specifically the hegemon that has just been putting all the excess goods they've been purchasing on IOUs with an interest rate payment. And that's the grand problem. Nobody wants debt as asset instruments. It's also the political driver as to why Trump is withdrawing from Europe, doesn't want to fund NATO, says you go fight with the Russians. We won't do it, but we'll sell you the arms. He needs to do trade and do deals and get income coming into American corporations at the European cost, and has no interest at incurring additional debt expenditure themselves. They're already on the parabola. And you can't chase a parabola, by the way. The mathematics are predetermined. You're dying. It's done. No one can chase a parabola. It's like chasing the rock avalanche that's halfway down the mountain hill. It's hitting the village. It's over. Doesn't matter. You can't run after it, and you're not going to catch it. It's running away from you. It's parabolic in its momentum gain. So that's essentially where we are. And there's a lot of disbelief and hypernormalization of what a debt-based collapse and fiat collapse. You're talking about poverty, cost of livings on a grand scale. It's a polarization of the Western world by those who prepared and actually retain value through gold, silver, and I would say judicious investment in existing miners. Not there will be speculative frenzies to come and a few scams to boot, and that's when you'll know that the precious metals market is truly on, when you have a couple of rip-off events. So that's why I warn against exploration and business plans with nothing more than a hole in the ground. But if you're positioned well and early in that, the moves are going to make you the money, and it's face melting. And it's not the NASDAQ. I get frustrated. Everybody, what do you think about the NASDAQ? And is it a blow-off bubble, or what is it doing? It's re-rating downwards in gold ounces. The way to measure wealth right now is gold ounces. Are you gaining them or are you shedding them? If you're putting all your money in Nvidia and all those things, regardless of how well they've done previously, they are currently losing value in gold ounces, whilst nominally going up. And that's because the measuring tool you're using is a dollar, which is in the convexity phase of losing value on an extreme level. But in short, America needs to get to a point where the goods it exports balances the goods it imports. It's no longer going to be a hegemony. It won't have the privilege of throwing IOU paper. People aren't going to do it. China is rolling out a system with vaulting in all the core hubs. Middle East, it'll be in Switzerland, it'll be in Singapore, it'll be in Shanghai and Hong Kong, potentially a place in Australia at some point, Sydney, and maybe one or two Western nations, but gold-backed vaults where trade will be balanced against an asset. And people will get to choose. You can have the treasury debt fiat system that America is on the fag end of collapsing, or you can have a system where there is clear, physical, audited, verified gold in places that is backed, and you can trade against that, giving people confidence.
Right.
And people are going to vote for the confidence, and that's going to be the end. It's going to take away further demand for treasuries and dollars, and it's going to be the final rug pull once instituted. There is no choice. It is a beauty queen next to a leper.
Yeah, and what about the tariff income that the US has generated so far this year as a result of Trump's policies, something like 146 billion? Is that going to make any difference?
None whatsoever. So in one particular month, the tariff amount was 30 billion. It was the month ended August, I believe. And in actual fact, they had a standing tariff income of around 7 billion from Biden's policies. So actually brought in a 23 billion net increase. In that same month, his farmers that are now facing in soybean industry alone, his farmers are being subsidized by 16 billion. The Chinese have withdrawn buying soybeans from America. And in fact, Argentina getting bailed out, the Chinese are now buying from them, where they were following them, putting counter tariffs on America's soybean farmers. Then you add how much money was issued in that same 30 days that he got 23 billion net in new because of his policies. He's spending 16 billion on a single industry to bail it out. That leaves 7 billion next. Never mind all the other industries that might need bailouts because they've also got counter tariffs on them and are no longer financially viable for goods being sold in the market. He issued, or the US issued, 550 billion in new debt. So you make a net of 23 billion. You're taking 16 billion of that to give to farmers in a single industry, soybean farmers, not even all farmers. That's not other agris. That's a single item bailout. You're down to 7 billion net, and you've issued 550 billion in new debt. As I mentioned, there's no chasing a parabola. There's another narrative that's going around, which I may as well debunk while I'm at it, and that's that USDT, the crypto stablecoin, is going to suddenly be the final buyer, and other stablecoins like it. That is going to be this bottomless pit of demand for this absolute runaway debt issuance, because they're now issuing debt to pay interest. They're moving everything. They can't afford the rates on the long end. They've moved everything onto the short end, which means the money keeps coming back for rolling much, much quicker, which is the beginning of the absolute end, because now you're rolling your debt all the time, and you're adding new debt into that mix, it's going to absolutely, it's like the big cog on your back wheel of a bike and the small one. The spinning rate is going so fast that you need so much new money to come in. The Treasury, since USDT has been in existence, they have bought 127 billion in treasuries. That's 2014 to 2025. 11 years of buying treasuries, 127 billion. And you've just issued 550 billion in 1 month. In 1 month. So you haven't, in 11 years, done enough to pay for 1/4 of 1 month's new issuance. Again, there's no chasing that parabola. The rate at which they're going to have to take every stable coin, even if there were 5 other like it, to multiply that, and the rate that they would have to buy treasuries. Everyone thinking Trump's playing 5D chess, or there's some mastermind Besant or some other dark state handlers that have got this great escape plan. This is cope. This is mentality. This is to sow confusion and think everything will be fine. Everybody is queuing up under the there, keep calm and carry on queue, and no one is queuing in front of, it's a real crisis, you don't own enough golden ounces queue. An honest truth is not nearly as desirable as a comforting lie, and there's all sorts of phony narratives that are completely hopeless of really offering any way of engineering your way out of the absolutist sense. And you can take me onto the bank and call me a fool on Twitter if they ever find a trick for this. You're going into a debt and fiat-based collapse. The dollar's loss of buying power is going to be absolutely epic, and that is going to fuel gold immensely, and it's going to fuel loss of buying power in other Western European nations, though not necessarily quite so much, unless Britain or France rushes to be the first to have their debt-based collapse before America. But America is the big one, and the hegemon falls from a far higher ladder.
Yeah.
And it is the biggest crash. So let me leave you with that to unpack.
No, very interesting. I do also hear theories that Uncle Sam, Trump are forcing, for example, European countries, because of the tariffs, to have a balance of payment problem eventually, which would force them to sell treasuries that the US Fed then can buy with a discount, and in that way reducing the US debt load. Is that something you think makes sense?
Slave nations, I caught the tail end of that. I'm not sure I got every part of that, how he will force Europe to buy treasuries.
But there's a dollar shortage, like and European countries need dollars. Of course, there's swap lines with the Fed, but let's say they need dollars and they get those dollars by selling treasuries. And if they panic sell them, there's a chance for the Fed, for example, to buy up those treasuries with a discount. In that way, reducing the debt load for the US, because of course, if the Fed owns them, they can also cancel them. Is that a way to effectively lower the US debt position by forcing other countries to basically sell them at a discount?
To buy them at a discount?
Yeah, so let's say European countries would sell at a discount because they're forced to sell their dollar assets because they have a dollar shortage, because, for example, of a balance of payment situation, because they don't export as much anymore to the US. Yeah. And they need to panic sell, and that could be an interesting opportunity for, let's say, the US government or the Fed to buy its own debt for a lower price.
It's best to keep these things simple. There's a redundancy of an over-proliferated asset. Does it go up in value or down? No matter what any smart aleck and last-minute juggler tries to do, does an overly proliferated, fast devaluing asset, both in its fiat terms and in its actual own capital value, does it suddenly become attractive that rationally minded people and nations will want to accumulate it? Very much no. There's no way you make it attractive again, because it's in a currency that's debasing and it's in not. Now, you can try violently force people to buy a non-productive asset, which I call is the not-for-profit trade, and you have vassal states such as Japan, the United Kingdom, and Benelux. You've got Belgium and Luxembourg.
And the Netherlands, where I'm based,
the Cayman Islands, which are probably CIA, Mossad-based proxies for maintaining the Ponzi scheme with, some offshore elements with some leverage involved where they borrow, surreptitiously against some fake collateral and are buying. All these on not-for-profit trades. There is a large, the foreign accumulation of treasuries. China is no longer accumulating. Clearly, Russia is not. Any nation that is building towards fair money and sound money is not accumulating treasuries. All the Western nations that are captive to this particular genre to varying degrees are slaves. We had the UK and France straight after hitting the headlines, both of them for debt-based issues of their own in their own country, be the biggest growing buyers of US treasuries at the end of last month.
Yeah, it's crazy.
You're talking about the sick leper wanting to kiss the chief leper even more and rub scabs together. I mean, they are so committed to going down with the ship that they have shackled themselves to the mast. And they are the only ones that will do the not-for-profit trade. And it's a controlled demolition of intent. There is no economic sound money politically in the European zone, the United Kingdom, Australia, New Zealand, and Canada, the rest of the English-speaking Western world, and all of Europe in terms of this.
Yeah, it's a race to the bottom. It's basically a bunch of Titanic sinking at the same time, and sometimes people at one Titanic try to push the other Titanic even down faster, or sometimes they help try to pull it up a little bit, but it's in the end a race to the bottom. And some of these trickeries can be perhaps used to delay certain situations, but in the end, it's all going down together. And the clearest way to see that is if you look at the price of gold, which, because the Dixie has been stable, so the dollar has been quite stable, but gold has been rising in all currencies aggressively, because last time we spoke, gold was consolidating for a few months. But since we spoke, it's not because of our video, because I think it has more to do with, for example, the latest Jackson Hole speech of Jerome Powell. But gold has been going up like crazy. Clearly, markets saying, look, we don't trust any of these currencies anymore.
Yeah. I mean, we say it's very much as we used to say it because of the CV19, but the orchestrated, synchronized, controlled demolition is very much the game you used to play as a child. Ring a rosies, a pocket full of posies, a tissue. We all fall down, and that seems to be the conjoined cultic approach of controlled demolition of many great nations, which is tragic. It has real repercussions, but it's especially bad. And there's a lot of US commentator cope. It's especially bad for the nation that does the least production and the highest of importing. And America is incredibly reliant on imports, incredibly reliant on foreign support for its debt and treasury market that is actually withdrawing, apart from all the slaves that are being buried with its fairer nations, which are the Japan, sadly, the United Kingdom, and to some degree European nations. Any smart nation is accumulating, and Poland, for example, is ramping its gold and has decided not to be part of the European death cult. And I would imagine there might be some other Eastern European nations that are neighbors to you and where you are that are actually positioning to be a little bit smarter. Right. And those will survive far better as part and parcel of credibility, collateral, and everything that is required. And there's a host of lies still to be exposed that will only be clear in a post-mortem of the ashes of the collapse of the American Eagle. And one of them might well be that there was not much in Fort Knox at all, or it was hypothecated away to many others. I don't know. You don't know until the event, the burn it to the ground event has happened, but it's going to be very, very damaging for most people. And we've referred, our most popular YouTube was in 2017 on Greenwich Hill, where they, the Greenwich Meridian line for the world was agreed through the observatory on that hill. And it was famous for its astronomers. We said there's a polarizing event coming. And sadly, the 99% are going to be on the wrong side of it who don't heed the warning that I'm giving. This is it's an apocalypse of financial events. You haven't got economic case history that encompasses the coordination of an entire hemisphere, Western hemisphere, which also includes obviously Australia and New Zealand on the southeastern hemisphere, in a controlled demolition of debt and fiat. And the buying power that they will have when they can only buy from China that which they sell, and there's a rebalancing of those books, and there's no longer the aspect to use debt markets to the same degree. is going to be absolutely debilitating, and their currencies are going to re-rate downwards, whatever is left of them. And I'm sure there'll be CBDCs and all sorts of other things, but the cost of living is going to be very, very hard. And this is part planned, because if you look at the population of the world, the Western world is like this, and the rest of the world's like that. In fact, in a circle that includes Southeast Asia and parts of China, you have more than 50% of the entire population. If we look at the income distribution on that small slither, which is us, basically Europe and the English-speaking nations, you have these high valuations, and everyone else is much lower. And this is part of the great leveling that I see as a Bolshevik totalitarianism, communism that is being uploaded globally, and for which the harshest downturn is for Western nations, which are just simply not accustomed for what's coming. And they need to talk to their Eastern European friends that are far less jaded and far less sleeping at the wheel, who've experienced this through their parents and their grandparents when we had the USSR and the neighboring states. It is going to be life-changing, and folks really need to wake up. There's a lot of cope and a lot of hyper-normalization of, we got by, it's just another day, another dollar. No, it's going to end. And the competing system is being unrolled for trade settlement as we speak, and the intentions are being announced. Yeah. And they do what they say they're going to do.
So and I get a sense that because you spend so much time educating people, you put all your time and efforts in this video, it's because you genuinely worry about the fate of most retail investors and people who are not prepared, who are not listening, who are basically going down with the ship, right? I get a sense that's the main reason why you do all this.
I'm rich already, but we'll all be a whole bunch more rich at the end of this. But it doesn't help to be there in a world of poverty and beggars and homeless people and school friends asking you if they can use one of your homes to live in. They've been turned out. They can't afford the rental BlackRock is charging on their ex-home because their interest rates got spiked and they got thrown out. It's you won't know who loves you for your money or for your wisdom or for who you are, because there's going to be so many people hurt by this. And I also fear that it goes with depopulation events. They will swing a sword over all of that through either major military. With every crash, they mask it with warfare because that enriches them, and inflation. And then they can say, well, who could have thought we would have this war and all of this BS and propaganda? We've got to prepare for your full preservation of your net worth. And there's very few things. Most things have been financially leveraged, including property, by the way. And valuations will go down in nominal and in real terms. And I keep talking about the gold ounce valuation. Advance your valuation in gold ounces. The best way you do that is you keep throwing fiat back at the fiat creators and debt creators, which have an endless printing machine, and you secure something that has real scarcity behind it and takes real energy to get out and refine.
Yeah.
And that's the trade. And everything else about stock markets and housing markets, it's an all no-go. Don't add anything there. It's a mono trade. This is foundational. I feel like there's a building like the Leaning Tower of Pisa, and let's call it an apartment block. And some people are going, well, what do you think of apartment 509 on the 5th floor? And should I paint it paint it yellow, offshade, or magnolia? And I'm going, but the foundations. The whole thing's going to be rubble on a piece of land. It's the post 9/11 controlled demolition. You're going to be looking at steaming steel. Why are you asking me what color you should paint the apartment? Are you not hearing anything I say? This is foundational to the nation. This is a complete burn it down to the ground. There is no other discussion worth having. Everything else is re-rating downwards in precious metals terms, apart from miners, platinum and silver, who will even outperform gold.
Yeah. Well, let's talk about the gold price and some of the predictions you have in store, because I saw this very interesting video that you made, I think yesterday even, about how gold can perform over the next years. I'm not sure what the time scale is, but you were applying some Elliott wave analytics on the chart, and I'm not going to yet disclose what the price targets could be, but just show our viewers, if you look at the chart, what gold could potentially do over the next few years.
Yeah, so on a super macro level, I've got the gold chart with as much history as we can afford. Before there was one bank in America, that was the Fed Reserve creation, which occurred round about here in 1913. Let's just put a marker for that, by the way. Let's call it 1913 over there. That's when in America they reestablished the fractional reserve and inflation will be a thing. Again, it would have taken them a while to get going, but don't forget, straight after 1913, we had the Titanic sink. A couple of big families went down that weren't working with the Jekyll Island, the creature from Jekyll Island, the Fed creation that they wanted. They got rid of those people, and then they went straight into the First World War of 14, 15, probably partially into 16 in terms of the negotiated settlement. It was the Treaty of Versailles. It was especially harsh on Germany. Russia chose not to be involved in the war. They got singled out. They got the Bolshevik Revolution that started in 17, 18, 19 through into the 20s that saw the slaughter of the Tsar, who had kept his country out of this war, and essentially the Bolsheviks take control over the Russian nation, and the slaughter that went, the largest genocide ever, which is typical of communism, and what goes, chronic slaughter and starvation that ran between 20 and 60 million. And then you rolled into the Weimar Republic, which many people are referring to now when we're discussing the gold, because Germany had an overly onerous debt and they had to print their way out of it. And you ended up with wheelbarrows of money and pockets full of goods instead of the inverse, etc., etc. That ended up in the 1933 build up to the 36th Second World War under you-know-who, and that panned out. And then we had the post-World War II system with America now the dominant nation. So if you were to run 1913, all of this was controlled markets. It was fixed pricing for gold, but the inflation wasn't as well entrenched, but it was beginning, and you clearly had a gap up between 20 and 30. That's when Roosevelt tricked his entire nation, which is what governments do. They treat you as the patsies in everything, and they make you be the bag carrier and make themselves solvent. They moved the gold up from $20 to 33 in the end, I think it was. And then later it went to 43. It crept up 35. So that was a sudden correction for accumulation of inflation. So this was known manipulation. They had a fixed price. And then that was the once-off correction, and then you got an extended period at that level where you got a further. So to me, this period is all one bull market to 800, because you had Vietnam, the 60s. You started with Tricky Dicky Nixon. Well, he didn't necessarily want that war, but they started with it before him with the tail end of Kennedy, who definitely didn't want that war. And he saw the Bay of Pigs things with Cuba and all the warmongery. He resisted it. It didn't work out well for him. Nixon ended up being railroaded by Kissinger and the rest into the Vietnam War. They became exceedingly rich. They dropped more munitions in Vietnam than all munitions in the entire World War II. Just because we didn't see it and feel it, they were flattening entire forests, Agent Orange, chemical weapons, every little dirty tricks they tried in there. And that, of course, was at the benefit of the military-industrial complex and the devaluation of the dollar. And people started to ask for their gold, starting with France, and that's when we then got this correction. So you could have, from 1913, just drawn a line that would have probably captured the aggregate degree of inflation, which is the debasement of currency. And you would have had a bull market like that. Instead, you had artificial manipulation. I'll come back to that manipulation because I think we've had a slightly more subtle version more recently, which is now unwinding. So that's your bull market, 13 to 1980. Then you had a 20-year bear market like that, kind of a falling wedge, which is a very classic continuation for the upside. We ended up at a low of 253 in and around this period, 99 and 2001, where you bottomed it. But it was basically peak tech stocks. In gold ounces, where the tech market is now, it's significantly lower than 1999. Okay, and it's rolled over and trading down. Gold is real money. Everything else is a fiat proxy. That is your bull and maybe your first down leg. Elliott waves have an AB, then they have a BC, which is a down leg. Then they have the largest leg, a CD, and then they have a DE correction, and then you have the final leg up. So it's a 5-wave formation. These are usually considered the same size, typically. It's not a golden rule, it's a proportionate aggregation. And this one is normally 61.8% of Fibonacci number bigger, 1.618. So it's that height and more in terms of how much you move between the two highs there. And my interesting thought experiment for you on a macro level of how high it goes is actually a question of how far the debasement goes before America's done writing down the value of its debt and its dollar, its associated dollar. So we are in, by definition, if you understand that little diagram of 3 legs up and 2 pullback legs, we are actually in technically a bull market that ran since 1913 to 1980. Call it a, what's that, 87-year bull and a 20-year bear on a macro level. That's your, let's put the letters in there so that everybody understands. That would be your A. I'll capitalize that. A, B, and this is your C. And the key point I'm making is that this leg is the biggest leg that we're in. And no, this little period is just a short correction inside this far bigger leg. That's actually a rising wedge melting up, by the way. And in fact, you could even argue that the whole thing is a rising wedge melting up. They have things in Elliott wave they call expanding flats. I'm not sure if it entails rising wedges as well. And I don't intend to do, I'm not an expert on Elliott wave, but you can go investigate that a little bit further for yourself. But the CD leg, if we were to model it with Fibonacci's and where the number comes out, I need a bit more high side space. This is in log scale, goes something like this. The extension, the Fibonacci extension of 1.168 from this low, which is, that's the 30s after the depression. I don't have to start at the perfect time, but if we go up there and to the low here, which was the low, and we pull that through, I'm just going to pull it through so that the band lies over the low. The 1.618 extension for the CD leg to end before you have, in years, probably a pullback. You've had a 20-year pullback. This was 20 years, 80 to 2000 or 99. That was your 20-year pullback. So that was your BC leg. You would need to get up to 107,000 in gold. But that's a statement more about the dollar than it is about gold.
Yeah, and when would that level be achieved then? What time we're talking about then? Is it like the 87 years of the AB leg, or even further down the line? Because it's the final
87. If you start at 1913, but you could have pushed it to the latest point, the bottom of the depression. At the bottom of the depression, you still had a $20 here. So let's say we took it from the bottom of the depression, which is sort of 1932. To 1980, you're going to be looking at about 48 years there. So you had a 48-year bull run, and you had a 20-year, put 20 in there. Now, the interesting thing with this is typically you go up faster and more furiously also in that third leg. You go further, quicker by time duration. So the movement from here, which has had its ups and downs, but generally is pretty single-minded. Just to make the same size leg would make 10,000, but to make the 61.8 would be well up at 107,000.
Yeah, and I can imagine in current times with all the technology we have and social media that legs are even compressed more. Perhaps it's not in line with the Elliott wave model, but I can imagine that when things go like we've seen over the past few days, things go fast, so fast, so high, so fast that
you're going to have
some of these legs can be compressed within a few years, maybe even.
Go look at the Y-mark Germany chart.
Exactly.
You'll have an absolute mania of near verticalness, and everyone will go, "This is ridiculous. Gold isn't worth that." No, it's not ridiculous. The dollar has to re-rate for the fact that it's totally over-proliferated to the tune of absolute trillions in debt, and not 1 or 2 trillions, multiple trillions. The bond markets, the whole Western bond market basis of existence has to be challenged. Where does all that value go if that goes zero? It's like energy. It doesn't disappear. It goes into something that we've gone from return on capital to return of capital. Preservation of capital that you still will have it the next day is a physical gold bar under your bed. Someone has to come to your house with a gun. It doesn't depreciate. It cannot be destroyed. We will recognize the value of physical. That's why they want to push you into digital, which is why, as I say, we avoid it. This could do a parabola in that you could be at, you don't even, this might even be to scale. Could all have happened. You could be at 107 in 2036, which is not even, a decade from now.
Right.
And it'll be even bigger. Then you have some form of meaningful correction to, maybe 30 or 50,000. And then you go again for another version of this. But there'll be a period of selling you the new digital option. If we get this whole thing to train out, I think markets will always exist because it serves them. Price discovery, brokerage, they see it as voluntary taxes paid by citizens. 68% on my IG account of people lose money. And on other platforms, it's higher, at 71, 72. And I think they mark those down. Probably in certain instances closer to approaching the 80s, and in some cases higher still. So, they love trading and price discovery and markets as a mechanism. Even communists do, because they want to own the brokers and have the people willingly come and throw their money at them. That's why we trade with HVF method. That's why we've been extracting massive amounts and turning it back into physical, just off trading gold in this last run-up. That's happening now. Those numbers.
Would you advise retail investors to also actively trade their positions, or just stack and accumulate?
So first of all, everyone should have an investment basis. This lends security to you foundationally. You must have cold pot. That's investment, no leverage, and physically held. It's with you. It's your call. You could go and deal out of it and buy food. At any point, bar one transaction, you've got substantial in there. Then you can start speculating only if you've been properly trained. You know how to use judicious leverage. You have always open stop losses and take profits in a methodology that you fully understand, and you have sized losses. Success in trading is knowing how to take small, regular losses without it psychologically damaging you, and trading for asymmetric upside gains with tight risk. That's how I trade. It's the only way I know to trade. It's how I help people learn how to do all those things, because saying it is one thing. What setup does it? Well, volatility constrictions, and I'll give you an example of one right now. We had the daily chart. This has been the easiest magic carpet ride for even the most nervous trader to endure. Is this. Literally, since we were getting in over here, you've been non-stop up. If I turn this into a weekly chart and just show you that same structural setup, this is what you've had. Every week you closed higher from when we entered for our community. Every week we closed higher. 1, 2, 3, 4, 5, 6, 7 to our target. You did not on a Monday mark the market as it opened to a Friday ever close lower than you started.
Yeah,
that's the gift
amazing.
of HVF trading that we do.
And can you also pull up the chart for silver?
Single-mindedly away from your entry aggressively to give you that emotional comfort.
Yeah.
When you are using leverage. That's it.
Could you also pull up the chart for silver?
Certainly. So we were in the Jerusalem Post, by the way. We've given a $330 call on silver. And that's our charts. That's my usual transgender pink draws. We say there might be a little bit of a small reckoning of rejection for silver before it goes. And it's once, twice, 3 times, and the 4th run you run. That article's there in the Jerusalem Post. It's interesting that they picked us up. And let's go here and talk about that silver. By the way, for those that are saying, but it's a bubble, it's too late, and all of this, when anything moves. As I say, this is economic history on a far greater scale than most people are even prepared to conceptualize. This is much, much bigger. This is the elephant in the room coming home. You have just triggered to us at the quarterly level. Those were that was your lip of what's popularly called a cup and handle. It's also something else that I'll do for you, and I'll show you the 330. You've had your first close of a quarter where you weren't rejected back down to the 37 level, even though these traded higher at the extremist point. They approached very close to 50. We haven't got there yet, but we're not far off. You are actually just at the point of the trigger and a potential dip back, a return move that may or may not happen. We're not saying it absolutely has to happen and how far. I don't think it'll be big, and I don't think it will be for long. That will then see face melting upside. The breakouts really only just started at this juncture. Now, because we like to be early and we have HVF method, which is the superior framing for the most technical trades, we were already in long, taking regular leverage longs in this breakout from here. And we highlighted that this was, in fact, a key breakout. Let's just refresh that and reload. This is our macro setup that draw came from the Jerusalem Post. And this is probably the single biggest technical pattern of our methodology that I've ever traded. I was still in school when this H1 was being formed. I was in junior school, which tells you as someone with a 5 at the beginning of his number now, how long ago that was. And this is our 330 target. And you have just run that first interim. The second interim, where you might expect a pause, comes at the 90.5, which makes absolute sense because $100 silver is going to be a major headline grabber. They're going to resist that. And then 330 thereafter. That doesn't mean you can't go higher. It just means it will probably have a lot of chop and churn and a bit of sideways, a bit of down that might go with it. So we are right here. So I showed you the cup and handle, how quarterly that's the biggest high, but there has typically been rejections in this band. You might pull back. You've just run our first interim. That's what we typically go. If you support there on that 40.929, I'm a buyer again. And the open areas in between, before you get to here, will be covered very promptly generally. And again, there to there. Those going to be face melting moves. But boy, it's not going to be good news if you're living in the West. It's definitely not going to be good news if you're in America, because it's going to be a dollar statement as well. And the cost of things for everyday people is going to be exceedingly high and shocking to many.
Yeah, I fear so too. And an ordinary investor, retail investor, what kind of percentage would you advise that person in terms of gold and silver? So if you have X amount available for precious metals, would you say like 3/4 in gold and 1/4 in silver, given your outlook?
So you're talking about total net worth, and you're also talking about apportionment to gold and silver.
Yeah.
In terms of total net worth, I see no other asset category. So I've done for many other people. It was beautiful little squeeze in there, by the way. It was a squeeze within a squeeze, which gives you incredibly high. That's your risk, and that's your entry, and that's your return. And in case that doesn't look spectacular enough, let me just show you what it is, and then I'll come back to your question. Long in there, that's there we go. I've already done it. You can see that is a 71.64 risk reward return. So for every 1,000 you risked, you're getting 71,000 back. It's incredibly high rate of return. So in terms of total allocation, apart from a home that you live in and any others that you might have as holiday homes or lifestyle homes outside of the Western era, expect those to go down in gold ounce terms, potentially down in nominal terms if there's a high leverage in that country, which most Western nations have. Not so much Germany, maybe, and one or two others. But the asset category, I'd be as much far gone into precious metals as anything else. If you can be, all in. That people think of portfolio theory. Portfolio theory is balancing in neutral, normal markets in normal environments. There's nothing normal about what's coming. It's a bit like me saying there's going to be an absolute famine. Well, you say, should I get 10% of my what I hold in food. No, if it's a famine, buy as much as you absolutely can. That's a unique set of circumstances where the premium will be food. If I'm saying to you a fiat and debt-based collapse is coming, there isn't enough gold and silver for you to own. Be outright in there. Of course, you still have to eat. You have to have some transactional money. Outside of frictional needs of transactional fiat and a place to live, I would be everything else. And then a combination of miners where you have share certificates, but I would certainly have the predominance in the physical gold, silver, platinum complex as real wealth stored. And I would have some security to go along with that. In terms of gold, silver split, I would actually say you can't afford not to have platinum if you can get your hands on it. I think it's cheap gold. It's harder than gold. It doesn't scratch. It doesn't tarnish like silver. And it's extrememely rare. And I have to do the mathematics because people say, well, that's kind of like, it feels like it's in nowhere land for many people because they think, well, it's $1,600, I can get more silver for that because silver's less than 50. Well, silver generally is 8 times more proliferated than gold. It's around 8 times more. So mining generally is 1:8. And gold is 20 plus, between 20 and 30 times more proliferated than platinum. You get about 3,000 tons globally in gold, 3,000 to 3.5. You get 190 tons of platinum.
Super scarce.
And it's a heavy metal.
Yeah.
So you times that by, let's go in the midpoint, 25. I've taken, that's how much platinum should cost now relative to silver, starting with a $50 silver. Or did I start with a $40 silver? No, multiplied by 8. Sorry, I started with 50. 50 times 8. So it's silver at $50, which it's not quite at, times 8 times 25, which is the midpoint between the numbers you get. It's it's cheap gold. And the only reason it underperformed for such an extended period is because we got the substitution with palladium that happened that used to be $100 when platinum was 3,000. So everybody was able to substitute. We were pivoting from diesel to battery. Now palladium is a couple of $100 behind platinum. And we're not doing that diesel, that pro-green thing to the same level. So you need to actually think of the platinum group of metals. Inside the platinum group of metals, one particular metal only recently discovered, where if you think 1969, and that's not that long ago in terms of gold's history, only recently discovered, ate a bunch of platinum's dinner. And that's why platinum underperformed. Go look at what palladium was doing while platinum was underperforming.
But then you could also argue to add all sorts of other commodities then to the mix, right? So where do you stop? So you can also add rhodium, that's the tricky thing, of course. Then it becomes a huge mix of metals that you should own physically, for example.
Well, you can't own them all, and I don't think you should try. But the main one of platinum has been artificially suppressed during the palladium running. So it might be just worth showing those charts so people can understand more of what I'm saying. Big time frames, you come to the right decision. There's no chance on big time frames. There's no odd market. Let's get a longer history one. And let's type the word platinum. We get the dollars and ounces. We want that one. So this is the work we've done here. What happened here, and you've only got data since 69, is that you had throughout this period, this high here, when platinum was 2,300s, that was when gold was 700s and 800s, by the way, in 08, and 600s. That's always been typically a multiple. It's far more scarce. What happened is if I split the screen, you'll see that palladium, when platinum was lackluster, palladium was running because it was potentially a substitute. That's not a good history chart. Let's get one with more history. There's one that should have more history. So go back and reframe that so those charts look semi-sensible. You can see from here, which was kind of the high, you can see what happened from here to that high. You ended up with palladium trading 3,000, like platinum closely did back in '08. And this substitution crushed it in a massive falling wedge that had just formed a wind-up upside HVF and just delivered target. And will have a small rest. It's also got a huge W bottom there, and up to here, which is broken as well, which has a 3,711 target. And now you can see palladium then corrected as platinum was getting ready to go quite extensively, and now beautiful rounded bottom and is starting to trade up. There isn't the difference anymore. When you were here and you had to buy platinum at 2,300, or you could buy palladium at 250, you were making, it was 1/10 of the price.
Yeah. Yeah, so basically a healthy mix of the four would be good: gold, silver, platinum, palladium. Then final.
I'd drop the palladium. I'd take the platinum. I think it outperforms.
Okay, great.
I'd drop the. You don't need to have all. You have one representative of the platinum group metal. Good luck trying to buy palladium. You're not going to get that from even the biggest bullion dealers. It's kind of tough.
Cool.
I would just take the platinum as your PGM metal. It is the king of that metal, and it should never have got as low as it did. And there was a very rare moment here when it was only 530, and actually palladium was more. Generally, it is the king of the platinum group metals. So when you sum these two charts together, actually the platinum group metals as a whole, never mind that rhodium had its own super streak, it's a smaller percentage, but leave that out. The platinum group of metals actually has outperformed silver to this point.
Interesting.
Yeah.
Final question. Also, if you could pull up that chart, digital gold, Bitcoin. For some, the new gold, for others, a scam. I like both gold and Bitcoin, but I wonder, how do you look at Bitcoin from a price and chart point of view?
Just the technical opinion I'll give you. People have gone to sleep in crypto now and become too bearish, and I think it's climbing. We had this guy in crypto, Ben Cowan, saying something, and we said no, he's too bearish. We think it's going to go up. It's going to have support. Let me just do this properly. I want the chart. I want BTC USD. We want Bitstamp. We said it's going to get supported at 108. It was coming down here. We said it's going to get supported. It came down again. We said it should get supported again, but it was coming down faster. And it ended up getting supported faster. You now have a W bottom here. This is going back into the range. So the 108 that we predicted would be, no, it's not trying to be ego. It doesn't matter. It's not about being right. It's about making money. We said it's going to go up from here, and it's going to remain supported, and people are a bit too bearish. It ran perfectly through a little upside HVF squeeze we had here, straight through this flag. That's why the 108 was a key level. And it was also a key level because of this double top. So we've maintained. No one else talks about 108. It's only here where you hear it, because we do the important things of key levels of significance. That's it. Support. And through the flag, wind up to break and leave it. You got it stuck into a broadening structure. You had to ease. You've now got a double bottom for upside. That is going to go higher and make a new high. We have a 150 target. But where everyone else gets it wrong, including this Ben Cowan guy who was picking us out, who was saying how bearish everything was going to be, and we're saying no, it's more bullish, is Bitcoin dominance. The alts are going to run far harder. We just have, this is a turn in dominance, by the way, in our opinion. So we've been watching this for an extended period, and we called for the Bitcoin dominance that's had over the last period since you broke this box. This is a very messy chart. Forgive it. There's a lot of levels in there. Let me just spread it out. Let's take the eye off first because it's so messy. We said you'll break out of this box. You'll go higher on dominance. That's happened. And the alt run only starts when that reverses. We called the reversal there and we were wrong. It reverted back up and it went higher. And now we think it's done. So you're getting a small rally now in Bitcoin dominance, because when you've had a slow period in crypto, it starts again with Bitcoin to get it going. But that's going to give up and go break to the downside is our house view. And when you look at it on the lower time frames, which I'll take you to, this is what we have. We had key levels from that were in existence here from previous setups, which is exactly why I believe this has happened. I think you're going to do a rising wedge here and break back down through these levels. So it's natural you support it. Oh, by the way, it did the exact same thing at other key levels we had identified previously there. You can see all these structures and key levels. You always get some form of interaction and winding up. So this is a reversal in dominance. And in fact, our current call right now for a major moon shooter is XLM, and we think XRP will be following it equally well. And by the way, the fundamental news that'll go hand in hand, and this is hot off the press, I've only just given this to my community and started adding our leverage trades on that, is this XLM chart. So I'll show you the macro story, the monthly one, why it's looking so good. Let's again take some of the detail off. This is a huge, again, structure of squeezing that is running through here. And inside of that, you're getting a squeeze within a squeeze. So we think you're going to come up, down, and then you're going to break really strongly. That's the macro monthly. We have a target of $14 on something that's 38 cents. So if they're going to get these rails of this system and cryptos working, they're going to have to pump their value up. And you can be sure all the right people have already got big holdings. And if I take you down into the daily chart, this is a 3 impulse falling wedge that has broken. So I'm going to just take some of the Fibos off. So XLM is very interesting, first and foremost, but XRP will be similarly good. We talk about 3 impulses in a falling wedge, and then you break up. Real support here. Support, support, support on that wick, support twice there, and coming up support, breakout of the falling wedge, which is crushed retail, selling, selling, selling across the top. Once, twice, 3 times, 4th time a lady you break, that's to the upside, and that's what we expect. So XLM to outperform Bitcoin and XRP to outperform Bitcoin, XLM being the pick, the smaller, the higher beta, in a bull market that's going to see alts start doing some face melting stuff. But I don't love any of these things. This is your status digital token. This is dispassionate. This is like talking about Apple and Palantir going up. Sometimes you just have to hold them to make the money. They're going to go up anyway. But that doesn't mean they're your friends. Gold and silver are your friends. They stand for truth.
Yeah, it reminds me of the thing you said last time. You know, it's good sometimes to make money within the matrix in order to build something outside of the matrix, and better to be a rich slave than a poor slave, like you said also. Well, thanks so much, Francis. It was interesting as always. Where can people find more about you? Of course, themarketsniper.com, on X, YouTube. You have a channel too. Anything I forget?
Yes, so pop over to YouTube at themarketsniper.com. On our website, YouTube channel called The Market Sniper, my X profile, The Market Sniper. Here's the 3 things we aim to do for all our members at Book a Call. You need to build wealth because what you're currently in is debasing rapidly. You need to build wealth. You need to protect and preserve your wealth as well. And point number 3, you need optionality in terms of where all that wealth is housed and outside of the harshest hits part of this world that we are in. That means outside of the Western world. That comes later for some people who don't have the means. Those that have the means can start straight away, which means residency's ability to reside somewhere without having to go somewhere else. Lower tax jurisdictions for Westerners by smaller nations like Georgia and some of the others we work with that give you capital gains for free. You've got to retain your wealth during this massive culling of wealth, and I fear also of headcount. And we need to preserve yourself against those things. Don't be in the high-risk areas to your wealth and to your personal existence. You have a family to look after. You have to think ahead of the game. This is an obstacle course. There is a real Bolshevik revolution coming, a technological, complex one coming for the Western world. Russia had its go, and they're coming for the Western world, both for all that you own and also potentially in a more sinister manner. We aim to help people prepare for that. Even if we are over-preparing, I would love for it to be wrong and all of the preparations to be unnecessary. We will be wealthier. We will have more freedom. We'll be outside of some of the more harshest jurisdictions where there will be real downforce, tax scavenge mode by corrupt and bankrupt governments that need to steal the wealth of the citizens directly now that they no longer have the inflationary debt spiral theft from their citizens that have been proliferating all this time. And we'll enjoy it. We'll have fun. You can learn how to trade with us. We've made great highs. Themarketsniper.com is your first call. All the links are in there. Thanks for having me on, Paul.
Yeah, thanks, Francis. A bucket of ice cold water, refreshing as always. I liked it. Look forward to doing it again with you in the future. And to my viewers, please subscribe to my channel, but also make sure to follow Francis. Check out his websites, check out his training program, and look forward to talking again, Francis.
Absolutely. And much blessings to all the Dutch friends that are out there and other Europeans watching this. Take action, please, for yourself, for no other reason, whether you do it with me or someone else.
Thanks.
Godspeed.